As the market starts September on a negative note for the most part, my next guest says the U.S. economy is headed for a recession if the Fed does not cut the interest rate, and by a lot. Joining me is Jay Hatfield, CEO and Portfolio Manager, Infrastructure Capital Advisors. Thanks for joining us today.
Thanks, Marilla. It's great to be on.
You have a year-end target of 6,600 for the S&P. What do you see as the drivers for this?
Well, we do think the risk is to the upside. The driver is that we do think the Fed will cut. Obviously, they've signaled they're going to cut in September. And it does seem disruptive that the Trump administration is trying to oust Fed members. But we actually think it's bullish because then that really locks in further cuts, so we won't have a recession. So whenever you're coming out of a Fed tightening cycle, that's super bullish. The AI boom is bullish, not just for tech stocks, but other derivative stocks like Goldman Sachs. So we think our target at 6,600 is probably too conservative. At some point, we'll probably institute a 7,000 upside target, particularly after we get out of this weak September period.
Okay, you believe that the U.S. will head towards a recession if that rate cut doesn't happen, and you think it has to be a significant rate cut as well. What number are you looking at, and are you looking at several different cuts?
Well, what's critical, so we're going to get 25 for sure, unless the Fed tells us otherwise, because they don't ever surprise the market. They leak it to one of your competitors, and they tell us. So we'll know when when we get through that window. But what's critical is their language. So we do think it'll be a bit of a hawkish cut, and that could affect rates. But what's good is that the market is anticipating these cuts. So in a way, actually, we won't have a recession as long as the 10-year comes down and we don't have 30-year mortgages over 7%, which we did very recently. So I watched the 10-year. It was trading off a little bit, but still well below its highs. So that drives the housing market, and that's what can trigger a recession.
How worried are you about the Fed's independence, political interference? You sort of did allude to it. Is it something that concerns you?
Really, not at all. It's important to note that the Fed's always been political, and the real check on the Fed is elections. So arguably, the Fed chair was pretty closely aligned with the Biden administration, particularly Secretary Yellen, and adopted the administration's view on transitory inflation. But then that administration paid the price because that high inflation was really the critical issue in the U.S. election. So we do actually think Fed independence should continue, but the new president, if there is a new president, he or she should be allowed to appoint a new Fed chair and new Fed Reserve Board members. And then if they make a big policy error and create either an inflation or even worse, a recession like the Great Financial Crisis, then they'll get voted out of office. So we're not worried about Fed independence. We think that's really focused on by bureaucrats who want to maintain their power. And it's really an artifice because the Fed's really never been fully independent.
Okay, I do want to get to your stock picks. One of them is Amazon. As you know, we saw the Mag 7 stocks move down significantly today, and I'm wondering if you think, and you mentioned that there's still some energy left in the tech lineup, and it's still going to be powerful for the end of the year next year?
Absolutely. We wouldn't necessarily go all in on Amazon like September 3rd, but we do. What's good about Amazon, it's more defensive than, we like Broadcom as well, but more defensive because it's kind of half Walmart and half Microsoft. So it usually goes down less. There was a negative report out on it, so it was down a fair amount today. So pretty defensive. We have a 300 target, so a lot of upside. Hasn't run up a lot. So we do like it. They have a cost-cutting strategy, which they hadn't had before Andy Jassy became CEO. So if you do use Amazon, you'll recognize that you get your packages like ridiculously quickly. That's because they're moving the inventory closer. That reduced costs. So we like that story. We probably favor more conservative investments through September, but into the year-end rally, definitely Amazon's a great pick.
All right. You also like tobacco giant Philip Morris. Why is that?
Same thing, really very defensive. Its beta is almost zero. So in other words, it does well when the market's terrible. And they are really a play on, if you're anti-smoking, it's a play on not smoking in a way because they have non-combustible products that are growing extremely quickly. So really, mostly because it's defensive and has like a near zero beta, which is really hard to find. So zero market risk, maybe even negative market risk for that matter, and a good solid growth story.
Okay, NextEra Energy is also on your list. Tell me about NextEra.
We like NextEra. It does have upside from AI because they do have a power development subsidiary, and we do think they're going to get contracts from the hyperscalers in the U.S. And then it also has one of the best utilities in the United States. It's in Florida. Florida is obviously a growth area, great regulation, very conservative, both government and then regulatory agency, good returns on equity. So you get a downside protection from the utility, upside from power development, and timely, as I mentioned, rates we think are going to 4% on the 10-year. So that's going to benefit utilities. And then they have this AI upside. And it's timely because September is a dicey time to be adding just super high beta stocks like tech stocks.
All right, Jay, I do have to leave it there. Jay Hatfield, CEO, Portfolio Manager, Infrastructure Capital Advisors. Thanks for your time.